Welcome to the deep dive. We're all about giving you that shortcut to being genuinely well informed. We sift through articles, notes, research, all sorts of sources really, and pull out the key insights for you. Today, we're getting to something powerful in investing, but maybe a bit overlooked sometimes. Market breadth. Yeah, this isn't about chasing headlines. It's about understanding what's really going on under the hood of the market, giving you tools to use data, not just gut feelings. So let's kick this off. What exactly is market breadth, and why should you, as an investor, really care about it?
Okay, so at its heart, market breadth is basically measuring how many stocks are actually participating when the market moves, up or down. Think of it like a doctor checking your overall health, not just taking your pulse, right? It gives you this much wider view of the market's real strength or weakness.
Mhm.
And that's so important because it takes you beyond just those maybe 5 or 10 huge companies everyone talks about.
Exactly.
Yeah.
What's really insightful, I think, is how it forces you to look past the Apples, the Microsofts,
Yeah.
the usual headliners, and instead you get to gauge the health of the entire stock market ecosystem. A lot of financial education stuff, particularly for the U.S. market, really emphasizes breadth indicators for that exact reason. They offer that holistic view. It's like asking, is the whole party enjoying itself, or is it just the loud group near the speakers?
Right, that's a great way to put it, moving beyond just the noise.
Yeah.
So, okay, that's the concept. But where does it get really useful? How does tracking this stuff actually help you make smarter moves?
Well, one of the biggest payoffs is potentially timing your investments better.
Hmm.
I mean, that's huge, right? When you see that most stocks across lots of different sectors are gaining strength together, well, that's usually a sign of a strong, broad-based rally. It means you can be more proactive, more uh, data-driven about when you decide to jump in rather than just guessing or, following the herd.
Okay, better timing. Makes sense. Can you maybe give us a concrete example, like a calming frap someone might fall into that checking breadth could help them sidestep, specifically about timing a buy?
Oh, definitely. So imagine the S&P 500 is rocketing up, hitting new highs. Headlines are all positive, right? It feels like you should jump in. But then you check the market breadth. And you find out maybe only a handful of massive tech stocks are actually driving that index up. And maybe, say, 80% of the other stocks in the market are actually going down. Breadth just gave you a massive warning signal. It's saying, hey, this party, it's pretty exclusive right now, and maybe it won't last. That tells you to be cautious, not just buy blindly because the index looks good. Without checking breadth, you could easily buy right at the top of a really thin, fragile rally, and then poof.
Ah, yeah, I see. That makes a lot of sense. Avoid the illusion of strength. Now, another thing our sources mention was using specific simple moving averages, SMAs, like the SMA 20, SMA 50, SMA 200. These are just the average closing price over the last 20 days, 50 days, 200 days. And they're not just random lines on a chart tracking how many stocks are trading above their 20-day average, for example. That gives you a quick read on whether the short-term trend is mostly up or down for most companies.
Precisely. And it's quite powerful. When you see a really significant chunk of stocks, a clear majority, trading above these key moving averages, say the 50-day or the 200-day, that's often a pretty solid signal that the market is genuinely healthy, resilient. It's like a quick visual check, almost like a pulse check, on the collective momentum of the market. Think of it like a sports team. Few star players scoring is good, sure. But if the whole team is consistently pushing forward, controlling the field, well, that's a much stronger, more sustainable position, isn't it?
Yeah, definitely a stronger foundation. And maybe one of the most crucial benefits is how market breadth helps you spot and hopefully avoid those nasty market traps. It really can act like an early warning system. It flags situations where the market looks strong, maybe the big indices are climbing, but it's actually just a few stocks doing all the heavy lifting.
Right. And that's fascinating how it functions as this warning system. It helps you sidestep those moments where the market feels strong. But that strength is actually, well, paper thin
Yeah.
and risky.
Uh,
You might glance at the Dow or the S&P hitting new highs and think, wow, everything's great.
yeah.
But if the breadth indicators are showing that most stocks are actually struggling, maybe declining, it's kind of like looking at a beautiful skyscraper, but knowing the foundations are crumbling. That market is fragile underneath, even if it looks good on the surface. Breadth helps you see that hidden weakness, maybe before it becomes obvious to everyone else. It's not always a sell everything now signal, but it's definitely a cue to dig a bit deeper, check the quality of that rally.
Okay, so let's pull this all together. If you're listening right now, what's the actionable takeaway? How does this all boil down for your investing strategy?
Well, the bottom line is really that bringing market breadth into your analysis just makes you a smarter investor, more confident too. It helps you identify potentially better times to enter the market specifically when you see broad participation, when lots of stocks are genuinely gaining strength. That gives your investments a much healthier base. And just as importantly, it helps you avoid buying at potentially dangerous times, like when the market's gains are super narrow, just a few big winners, or maybe look a bit artificial. Ultimately, understanding this deeper market dynamic lets you rely more on solid data, you know, less on just emotion or those fleeting news headlines.
It really is a powerful lens, isn't it? Market breadth, often overlooked, but incredibly useful for investing with more clarity and confidence. It pushes you to look past just the surface numbers and get a more nuanced picture of what's actually happening with market mechanics. We really hope you explore this more for your own financial journey.